My guest is Mrin Agarwal, who is a financial educator and the founder of Finsafe India. Thanks as always, Mrin, for taking the time. Let's start with the first question that I have, is that do you think that insurance is the most misunderstood product in financial markets currently?
Good evening, Alex. Really nice to be here, as always, on the Money Show. And yes, it is the most misunderstood and the most misbought as well, because I think most people undermine their insurance needs and are very, very underinsured as well.
That's a great way of putting it, because it's not just that they have a cover, oftentimes they don't have enough of a cover. So we'll discuss how much cover you need as well. Let's start with life insurance, Mrin. And I think the first decision to be made when you're going out and getting life insurance is, first of all, when to get it. Is there a threshold that you need to have, or is there some requirement that you need to have before you go ahead and buy? And then which to buy, of course, between term and traditional?
Well, I think it's always good to have a life cover if you have dependents. That's very important, because the reason that you take a life cover is that if you are no more, then at least the family members will be able to manage their living expenses and future financial goals with the life insurance amount. So I would say, of course, you need to start taking it as soon as you have dependents, and you have to keep increasing the amount based on your life situation. In terms of which policy to take, of course, the term plan is the way to go, because given the various financial goals that people have and the cost of living, certainly the traditional insurance plans would not stack up, because the sum assured in the traditional plans is very low. And finally, the overall returns also from the traditional plans are really low. So, without any doubt, the only way that you need to buy insurance is through the term plan.
So, and I'm not really going to finger point here, but just so that people understand, often when they are pitched these products, Mrin, there is a big number that they are presented with. So you can get 20 lakhs back in such and such number of years. Would you be able to help our viewers understand what component of their premium goes to what? And is there some way that you can break it down so that they understand what questions to ask when they get pitched these products?
Well, the first question is to really ask at what percentage return are these returns being projected. But unfortunately, I have seen this very often, where people are told that you will get a 10 to 12% return, and the typical return in most of the traditional plans has actually been only 4 to 5%, and we're talking about the investor return. So there is a difference in the fund return and the investor return. The fund would be able to generate those sort of returns, but with all the charges that are there, so you have mortality charge, premium allocation charge, administrative charge, fund management charge, and the many other charges that are there. When you put all of those charges, then the returns, the actual investor returns really come down. So I think what is really important is to understand at what rate these returns have been projected, and also to ask the agent as to what has been the typical return from most of these plans in the past. And maybe ask, I know it's a little too much to ask this, but maybe ask for an XIRR working. In all probability, you're not going to get it, but still, no harm in asking for it.
No harm in asking for the internal rate of return. The other factor, of course, is the amount of premium that you're paying, right, Mrin? Because the premium breakup for a traditional product, quite a substantial portion of it, like you just mentioned, heads towards that investment side of things, which is only netting you 3.5-4%, and the cover that you get is not adequate either, right? So what advice would you give in terms of how you break this up? Can you just ask up front how much of this is going towards the investment?
Well, you can, but I'm not sure if you'll get the right answer, because if you're being told that it's giving you 10 to 12% return, I don't think you'll get the right answer. And I think, people need to be aware that this is the way it works and that they should not expect these sort of returns. I know that there's a lot of disbelief when we talk about it, and I have, experienced this a lot, but that's what the reality is. And I think they should just stay away from it.
I'm not sure if we lost your line, but one last point on traditional policies before we move forward. I've heard so many people, Mrin, saying that, I bought this from an uncle, or I bought this from my school teacher's husband. And it's often people close to you that are selling you these policies. Is there a line that you draw that says that, okay, maybe I'm going to say that I'm not going to buy a financial product which I'm going to be paying a lot of money for, and that will likely affect my future from somebody that's that close to me?
Yeah, I think it's always better to keep money matters and people whom you know separate.
Well, okay. So let's get into the term plan now. All right. So how do you decide, now that you've decided, okay, you say that you have a financial dependent, and also I would think if you have a financial dependent and then take a substantial loan, like for example a mortgage or something like that, you absolutely must have term insurance. But how do you decide the quantum? And you say that you can go back and revise it over a period of time. How often do you go back and look at it?
So you can go to any of the insurance websites, insurance company websites, and they have something known as a human life value calculator, which will ask you certain questions like your expenses, your financial goals, loans that you have to cover for. And based on that, it's going to actually calculate and tell you how much insurance you need to have. That is the best way to actually figure out the right amount of insurance to buy. On the second point as to how often you revise it, well, you revise it, maybe after a couple of years, or if there's been a change in your life situation. So, for example, let's say you got married and you had kids, certainly you would need more insurance then, right? So, if there are any changes in your life situation, and of course, periodically over a couple of years, you need to assess whether you have the right amount of insurance, because your expenses are only going up, right? So, basis that, whether you have the right amount.
Okay. Now there are two ways, Mrin, that you've highlighted that you can pay the premium. Um, Based on what you've sent us, you can actually accelerate your premium payments. Is there an advantage associated? Could you break that down for us?
Sure. So let's take an example where you have a 40-year-old who wants to take a term plan for 30 years. Now, the person can actually decide and say that, okay, either I pay it over a period of 30 years, or let me pay it over a period of 10 years and be done with it, right? So the typical premium, I think it's for a 2 crore cover, the typical premium would be in the range of about 75,000. So let us say that the person decides, so the person has the 75,000, obviously, and they can say, okay, I'll pay it off in 10 years. So I'll pay it for 10 years, and then for the balance 20 years, for the next 10 years, I will invest the money, because you're assuming that it's a 40-year-old. So you're assuming that till the time of 60, the person can invest the money, right? So you're going to pay premium for the first 10 years, and then the 75,000, you're going to invest that money for the next 10 years. The other option is to say, I'm 40 now and I will pay the premium for the next 30 years. Basically, the premium is also going to be lower. It's going to be 40,000 rupees. So the balance 35,000, I will invest for a period of 20 years, right? Because I basically want to see, I basically want to only have the outlay till the time of retirement, right? So when you actually calculate the values, what you find is that in option one, where you're paying premium over a longer term period, over the tenure of the policy, you're going to have a higher amount as compared to when you're paying it for a limited period, right? So this is the mathematical part of it, basically. There's another part of it, which is really about your mindset and what you're more comfortable with. There are cases where people feel that I don't want to have this sort of outgo to happen as I'm closer to retirement or after retirement, and hence I would like to just pay it upfront, irrespective of the fact that I might end up with a lower amount as well. Also, the other thing in term is that you would not want to pay up in advance, because it's not going to really help you financially in any way, right? By paying up in advance, because there's no return on investment on the term plan. So I think, while financially it does not make sense to pay up earlier, a lot of people do end up paying up earlier simply because that's what they're more comfortable with.
Understood. Okay, so we've discussed life insurance in some detail, Mrin. Let's also talk about health insurance, and this, I think, is something that a lot of people have questions about. First of all, would you say that it's imperative for everybody to have health insurance, considering that people kind of say that, oh, my employer is providing me with a certain amount of health insurance, my partner has also got such and such cover. Is that enough? Should I bolster it? So first of all, should you have health insurance?
Yes, and I think it's very important to have health insurance over what employer cover you have, because what if you stop working tomorrow for whatever reason, you're not going to have this cover, right? So I think it's really, really important to have health insurance over what the employer gives you.
Okay, let's talk about this then. What are the important checks to have when you go out to buy health insurance?
So first thing, don't go by the premium, because the premium is completely based on the inclusions and exclusions, right? So the first thing to understand is what are the exclusions in the policy. So what is not included? What is the sort of waiting periods that are there? Most policies today, very standardized waiting periods across policies, but even then, do keep a check on the waiting periods. Are there any sublimits? So, for example, does the policy limit the amount of room rent that needs to be paid? Like in the first wave of COVID, this was very widely seen, where most policies had limited the room rent amount. And so people had to then bear those expenses on their own. Similarly, are there any limits on consumables, on tests, stuff like that? You will have to read the policy document. And again, you can get this policy document on the insurance company website. So, first and foremost, what you need to do is that you'll have to look at the various policies, evaluate the one that works for you based on the inclusions and exclusions and the sublimits, and then very carefully read the policy wordings to understand what are the implications. Again, nowadays, there are policies coming with something known as a deductible or a co-payment, which basically means that if the first, so let's say there's a co-payment of 10%. So what it means is that for every claim, the first 10% will have to be paid for by the insured, and then only the insurance policy is going to pay the balance amount. So these are the very important checkpoints before you buy a policy, and do not buy a policy just because it's got a low premium.
Yes, absolutely. It's not, I mean, you should never buy an insurance policy solely on the basis of premium, because there are several factors that could come into play. There is also something that people talk about, or other advisors talk about, as far as critical illness is concerned. What does one have to bear in mind about that, Mrin?
So critical illness is not linked to hospitalization. It gives you a lump sum on the diagnosis of a large illness, and you have to survive that illness for 30 days. So this illness could be cancer, it could be stroke, it could be coronary heart disease, it could be kidney failure and stuff like that. And essentially, you get this lump sum. Now, you can use this lump sum the way you want to. You could use it. So if you're not able to work because of this illness, it could be income replacement. It could be for miscellaneous expenses associated with this illness. Like, for example, if you need domiciliary healthcare, right? If you need help at home and you need to hire someone for that, then you might be able to use this money for that. You could just use it for living expenses. You could use it for loan repayment. You can use it for whatever you want to. Nobody's going to ask you how you're using it, right? I think it's very important to buy it. It's expensive, no doubt, because it covers all these very large illnesses. But I think it's really important to buy it. And it's better to buy it as a standalone because it's going to provide you a better coverage. And it's going to also probably include a lot more illnesses than if you buy it as a rider.
Okay, and it also makes sense to get this as early as possible, right, Mrin? Because that affects the amount of premium that you would pay over a period of time.
Absolutely.
Okay. There's also, now, I think perhaps one of the biggest questions that we get asked on this show, Mrin, relates to how do I cover my parents, especially once they cross that threshold of 60 years. They're no longer earning for themselves. They don't have cover from their employers in several cases. And it gets costlier, and there are more riders associated with getting insurance for people above a certain age. So how does one go about doing that?
So firstly, if you can get it early on, that's really good. Like if you can get it when the parents are in the 50s, it's better than trying to get it when the parents are in the 60s, but that may not always be the case. So there is something known as a super topper plan. And the advantage of the super topper plan is that it's very cheap. So how does it work? The way it works is that a super topper plan comes with a deductible. So let's say you buy a 20 lakh policy, then it comes with a deductible of 3 lakhs, which means that the first 3 lakhs on a cumulative basis through the year. So let's say you have multiple claims, the first 3 lakhs has to be borne by the insured, and the balance amount is going to be paid by the insurance company, right? So, of course, due to this, the premiums on this policy are very low. So, for example, for a 60-year-old taking a 20 lakh cover with a 3 lakh deductible, the premium is 10,000 rupees. You compare that to a plain base policy, 5 lakh rupee cover for a 60-year-old is going to be anywhere between 28,000 rupees, right? So there is a big variance in the actual premiums that you're paying. And the best part about the super topper policy is that there is no base cover required. So the main thing that you have to keep in mind in the super topper is that that deductible amount that you're signing up for, you need to have that amount available to pay in case of any claim. So that's the main thing that you have to keep in mind where the super top up is concerned. But I think super top up is a great way to buy insurance cover at a low cost. I would actually say it's like in life insurance when you're buying a term plan. It's similar in health insurance. I would actually call super top up the equivalent.
What about amount, Rin? Is there a thumb rule to follow? And also, I've heard this suggestion that is made often that if you are in a if the child if the okay, so if the senior citizen has children that are working and they have coverage from their corporate, the company that they're working for, and if the company provides a certain amount of cover for the parents, then you should absolutely take that, even if it requires you to pay a little bit more. One is that question, and the second is how much should you take? What is the amount of cover that you should take?
So as such, a family of 4, you should always take parental cover separate. But a family of 4, I always advise at least 20 lakhs cover. The reason being that today to treat any large illness, that's the sort of thing that is going to cost you anywhere between, let's say, 5 to 20 lakhs. So it's always good to have a good amount of cover. And I think this is a necessary expense. Whether you use it or not is immaterial, but I think you should be prepared for this uncertainty. So I think buying a 20 lakh family floater with a 5 to 10 lakh critical illness cover is a good cover to have. Of course, depending on your age, it will cost you anywhere between, let's say, 60 to 80,000 rupees per year. But I still think that it's a very, very important cover. Similarly, for the parents to have a 20 lakh cover is a good cover given the cost of medical treatment. And yes, if you can buy a parental cover through your group policy, it's a good idea because typically the waiting periods might be lesser, the terms and conditions might be more favorable. But always keep in mind that they too need to have that external cover, simply for the reason that if you decide to stop working or you stop working for whatever reason, the cover is going to stop right there and then. So ensure that you have some external cover as well.
Very good point, because and during the interim between two companies, there shouldn't be an issue, right? So, but thanks so much, Mrin, for joining in and for taking all of those questions. And viewers, if you've got any additional questions, I'm sure that Mrin will be happy to either take them separately or, in fact, join us back and address all of them. Mrin, as always, a pleasure speaking with you. Thank you so much for taking the time.
Thank you.